So what we're going to talk about are life insurance settlement options. So what this is when the insured dies and the beneficiary receives the payout for the death benefit, there are a few different ways that this person can receive that money. That's called a settlement option. So it's either when the insured dies or the endowment is reached, typically when the insured reaches age 100. Some policies go to 120, but a lot of it's age, most of them, 99% of them are going to be to age 100. Now, once a settlement option is selected, the beneficiary can't change it. But if none are selected, the beneficiary can choose one. Okay, so say the person who's insured, if they say, well, I want this settlement option, the beneficiary can't change that once the insured dies. Okay, so first one here, cash payment. That's the most simple one, right? Death benefit. Say there's $1 million death benefit, and then the insured dies, then the beneficiary gets a lump sum check. It's not taxable. Okay, very simple, straight cash check, death benefit. Next one is life income. Okay, say hi, Leia. Say hi to the insurance people studying, to the insurance gurus. Okay, life income. Next is life income. So the beneficiary receives an income stream for the rest of their life. So let's say someone passes away, there's a $100,000 death benefit, and instead of getting that one lump sum, the insurance company estimates how long the beneficiary is going to live, and then they pay out monthly based on how long that person they think it's going to live. I'll give you an example below here. So if the recipient lives a long time, they make out. If the recipient dies young, the insurer keeps the remainder. Some options allow for the remaining funds to be paid to someone else if the recipient dies early, but that results in a lower income payout to the recipient. So here's an example. This will clarify it. So we have a $100,000 death benefit, okay? The recipient, this is an example. This is not exactly how it would be, but these are just round numbers for you to get an idea of what this is in a visual standpoint. So say the recipient lives 20 years, 20 more years. It's okay. When the insurance company says, beneficiary, we think you're going to live 20 more years. So say they're going to give them $5,000 per year because $5,000 times 20 equals $100,000. It's not always that simple, but this is the example. If the recipient dies in 10 years, the insurance company actually makes out, and they only paid 50 grand on the whole thing. Okay, so they said, we're going to give you 5,000 a year if you live 20 years and the full thing's paid out. But the insured dies within, or the recipient, sorry, not the insured, the recipient dies in 10 years. So actually, the insurance company makes out because they only paid 50,000. So the insurance company keeps the remainder. Okay. Now, if the recipient dies in 30 years, the insurance company actually lost, and the recipient made out because he outlived his life expectancy. So if that's the case, then the insurance company actually paid 30 times 5,000, which is 150,000. Okay, so they actually lost out. Now, there are options where they can say, hey, like this life income with period certain. So this is when you select a time period that the income is guaranteed to be paid out in. So what this does, this puts some guarantees that if the insured dies, I keep saying insured, if the recipient dies early, that the money can still go on. So one of them is a life income with period certain. So this is a time period that the income is guaranteed to be paid out in. So it's not compressed all into that time period, but they say, hey, for at least this many years, we guarantee if you die, that someone else is going to get that income payment for the remainder of that time. So if the recipient dies prematurely, the income will continue to be paid to someone else for the remainder of the time period. So here's the example. In the above example with the $100,000 death benefit, let's say they do life income with period certain and select a 10-year period certain. So that's $5,000 a year for 20 years is $100,000 once again. But now because they elected the period certain, the payouts would be less because it's an extra feature. The insurance company is taking a larger risk. They're guaranteeing it, so they're going to pay out a little bit less money. Okay, they're taking a larger risk, saying, "Hey, you could die, but we're still going to have to pay the money out." So let's say it drops to $4,500 per year, right here. So instead of $5,000 a year, they're getting $4,500 per year. Okay. If the recipient dies in 5 years, that means the other recipient would receive the remaining $4,500 for the 5 years left in the period certain, because we had a 10-year period certain. Okay. They say, "Hey, we're going to pay you $4,500 a year until you die." Now, if you die within the next 10 years in that period certain, then we are going to continue making the payments to someone else until that period certain expires. It's really what it is. Next is the interest-only options. By the way, if you find value in this video, subscribe to the channel, turn on post notifications, and email me at jve@thejve.com if you want to learn about what it's like to work here at Senior Life Services, where we provide everything you need to be successful. We give you free leads, great commission structure, coaching, mentoring, training, everything else. So in this situation, the insurance company keeps the death benefit, greedy pricks, and they pay out interest earned on it to the beneficiary. Now, this is temporary until another settlement option is elected. Okay. Example: $100,000 death benefit earns 2% interest, so $2,000 per year gets paid out to beneficiary. Right. So say they have a $100,000 death benefit, and it earns 2% per year in interest. Then $2,000 per year gets paid out to the beneficiary. Now, this is usually like a temporary thing. So the beneficiary says, you know what, I don't know if I want a lump sum. I don't know if I want an income stream. I don't know what I want, to be honest. So I'm going to have you pay me just the interest on the money. You hold it, and then I may select what option I want. I may take the whole lump sum. I may take, have a cash pay, like a lifetime income, whatever. Now, once the beneficiary dies, the remainder is paid to someone else. So say they die before they can make up their mind of how they want it to be distributed, someone else gets that lump sum. Or it can be other conditions that trigger the payout too. So there's other things that can trigger when this gets paid out. Or the beneficiary can elect a different settlement option too. So they can say, you know what, I don't want to receive the interest anymore. I just want to get the cash. Next one, fixed period. So installments made for a specific period of time. If the beneficiary dies, the payments continue to someone else for the remainder of that period. So for example, the whole $100,000 to be paid out within 10 years will actually be more than $100,000 because the principal, the whole amount, the $100,000 will still earn interest in one of the insurance company's account. So if the recipient dies before the 10 years is up, it continues to someone else. Okay. So what this means is, say they get paid, there's a $100,000 death benefit. They say, I want it to be paid out in 10 years. Those payments, they're going to get the same amount every year. And if the recipient for that money dies before that 10 years is up, someone else is still going to continue the payments. And once the 10 years is up, it's over. That's it. Next is fixed amount installments option. So this is the last one here. The fixed amounts installments option pays a fixed amount until the whole amount is gone. So what that means, it pays a fixed amount of money until the whole benefit is gone. So example, say I want $10,000 a year out of the $100,000 until all the money's gone. Now that $100,000 will still earn a little interest, so they'll end up getting a little more than $100,000. But this guarantees all the money will be paid out. So you can see there's a few time period options. One says I want the income for life. If I die young, that's my bad. If I live too long, that's your bad. One says I want all of it to be paid out in a certain time period. And then another one says I just want a specific amount every year until it runs out. Okay? So those are the different, and then you can also receive a lump sum in cash. So those are the different settlement options that you can use for a death benefit. I hope this helps you pass your life insurance licensing course. If you want to check out this video up here, you're going to see every single life insurance policy that you're going to need to know to pass your exam.